For decades, Bernie Madoff delivered something no one else could: consistent returns. No volatility, no drama. Through recessions, through market crashes, through every kind of uncertainty. It was, of course, too good to be true. And in 2008, the illusion finally collapsed. What followed became the largest Ponzi scheme in financial history, wiping out over $60 billion. This is the story of how that lie survived for decades. Bernard Madoff wasn't some mysterious outsider. He was a pillar of Wall Street, a former chairman of the Nasdaq Stock Exchange. His firm, founded back in 1960, was respected and deeply embedded in the financial world's infrastructure. Institutional investors trusted him. Major charities trusted him. Wealthy, influential families trusted him. When asked about his method, he'd describe it as a split-strike conversion strategy. It sounded complex, sophisticated, and highly technical. The truth is, very few people understood what it actually meant. But they didn't need to, because the returns spoke for themselves. They were steady, predictable, landing somewhere between 10 to 12% per year, almost every single year. That incredible consistency built an unshakable belief even when markets were in freefall. Think about it. Markets fluctuate. That's what they do. Even the world's best hedge funds have down months, down years. They experience drawdowns. But Madoff's returns, they barely moved. During the dot-com crash, his fund was stable. During the market panic after 9/11s, it was stable. During any period of financial turbulence, his clients' statements showed that same, steady, upward climb. Now, this should have been the first major warning sign. Returns that perfect just aren't possible. But instead of raising alarms, it became his ultimate selling point. Investors saw that consistency and thought, this man must be incredibly disciplined. He's a genius. In reality, that consistency was completely fabricated. The SEC would later discover there were no large-scale trades happening that matched his reported strategy. The trade confirmations his clients received were often manually generated, sometimes backdated, and printed on an old-school printer in his office. The entire illusion was maintained through paperwork, not performance. So, how did it actually work? The mechanism was shockingly simple. New investor money was used to pay off withdrawals for existing investors. That's it. There was no massive, sophisticated trading engine generating profits. It was just a continuous cycle of cash inflows covering redemption requests. As long as more money came into the fund than went out, the illusion of profitability could survive. This is the core structure of every Ponzi scheme in history. But what made Madoff's scheme so different was the unbelievable scale. At its peak, the client statements he was sending out reflected a total value of over $60 billion. The actual recoverable assets in the bank, they were just a tiny fraction of that number. The enormous gap between those two figures was pure illusion, built on decades of lies. What makes the Madoff case so extraordinary isn't just the fraud itself. It's how many warning signs were missed by the very people supposed to prevent this. A financial analyst named Harry Markopolos repeatedly warned the SEC about Madoff. He submitted detailed reports, mathematically demonstrating that Madoff's returns were statistically impossible to achieve legitimately. The SEC did investigate Madoff multiple times over the years, but no major enforcement action ever followed. Why? It was a combination of factors. There was an institutional reputation bias. Madoff was too respected to be a crook. There was complexity avoidance. His strategy seemed too complicated to properly dissect. And there was a deference to authority. Investigators were hesitant to challenge such a powerful figure. Madoff's status on Wall Street acted like a shield. The oversight mechanisms were there, but they were simply not used effectively. Then came 2008. The global financial crisis sent shockwaves through the economy, triggering massive redemption requests from Madoff's investors. Everyone wanted their money back, all at once. At the same time, the inflow of new capital slowed to a trickle. The whole structure could no longer sustain itself. The money coming in was not enough to cover the money going out. The game was over. In December of 2008, Madoff confessed to his sons. He sat them down and admitted everything. It was all, in his words, one big lie. He was arrested the very next day. In 2009, he was sentenced to 150 years in prison, the maximum possible sentence. The illusion had finally shattered. The consequences were absolutely devastating. Entire retirement funds were wiped out overnight. Charitable foundations that had been operating for decades collapsed. Families who had invested their life savings were financially destroyed. The total paper losses were estimated at over $60 billion. While recovery efforts have since managed to return a significant amount of money to the victims, the trust that was broken is not so easily restored. The case forced major regulatory reforms and brought a new level of scrutiny to the hedge fund industry, but the scars remain. In the end, the Madoff scandal wasn't just about greed. It was about belief. The belief in an authority figure. The belief in the power of exclusivity and access. And most of all, the belief in consistency. Financial fraud thrives in an environment where skepticism disappears. And the most dangerous lies are not the loud, bombastic ones. They are the quiet, consistent lies repeated year after year. Because sometimes the illusion of stability can be far more seductive than the promise of profit. Thanks so much for watching. If you found this story interesting, consider subscribing for more deep dives.